Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Bootcamp. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you're joining me here today. We are going to talk about how to vet passive real estate deals. Now, this isn't just about vetting the deal. We're also going to talk a little bit on how to screen the market that you are investing in as well. So I'm so happy that you're here because we do this boot camp live every month to help you learn a new skill when it comes to passive investing, but also fortify your current skills. So I encourage you to attend these boot camp sessions. We keep these very skill based. We're going to dive deep. We're going to help you create a system here. So if you are listening to this on your favorite audio player of choice, I encourage you, go to the video on YouTube at passive investing dot is spelled D-O-T, C-O-M, at YouTube, and look at this video. That is going to be so critical in helping you set up the systems on how to actually vet a passive real estate deal. Now, if you haven't done so already, make sure to join me at passiveinvestingwithwhitney.com. There, you're going to get access to all of our Passive Investing Made Simple masterclasses, and as well as our skill building boot camps. And you can also jump on the phone one-on-one with me. We can talk about how passive investing in real estate, like multifamily, self-storage, express car washes, stuff like that, even real estate notes, can help you meet your passive investing goals. All right, guys, let's dive in. And this is the time that we're meeting each other. First of all, welcome. I'm so excited to have you here. What we are, I guess I have some questions for you. In this bootcamp, we're going to help you understand and eliminate some myths here, answer some questions. And these bootcamps are geared for those people. Maybe you've tried investing in real estate before, or in a passive deal before, but couldn't get comfortable with it. Or maybe you actually invested in a passive investing deal and said, oh, I made a mistake. Or you just want to get involved in a passive investing deal, but you're just so overwhelmed by all the information out there. These boot camps are meant to help you focus on the skills needed to overcome all three of these objections. So I hope you're, ready to learn the biggest myth that keeps most investors sidelined, or they never get involved in a passive deal. We're going to learn how to screen markets properly, screen deals and vet deals properly here today. I'll point you back to a previous webinar that I did last month on how to screen operators. And we're going to help you actually, again, put together that checklist for yourself. So again, now you have a tool that is tailored to you and can help you go into your next deal with more confidence. Now, let's dive in. The number one myth that I encounter when I'm talking to passive investors that keep them sidelined from either going into a deal or going into more deals is that they feel I have no control, which simply isn't true. Think about it. When you go into stocks, bonds, and mutual fund, how much control do you have over that company? Zero. Okay. How much control do you have over which tickers get put into that particular ETF or mutual fund that you invest in? Zero, because you don't have any impact on the mutual fund advisor. But when you create your own passive real estate portfolio, you get to invest in deals that specifically align with your goals, your risk, and your timeline. Deals that are with operators that you know, love, and trust. And also going into markets that you understand. And then more importantly, you get to look on the inside on every single one of these deals. All right, so let's dive in. If we haven't met before, my name is Whitney. Again, I'm the Director of Investor Education here at PassiveInvesting.com, and this is the whole reason why I invest in real estate. And so I can travel the world with my crazy crew here. I started off real estate investing back in 2002, doing live-in flipping and house hacking, progressed into buy and hold rental real estate, then into smaller multifamily deals, and eventually larger institutional grade deals. Doing a lot of these things actively, but what unlocked financial freedom for us was this portfolio that I built in partnership passively. And so fast forward to today, this is just a few of the numbers, into my portfolio: over 6,500 multifamily units, 2,200 self-storage, 15 express car washes, a myriad of other investments, but it's the result. And that's what I bet you're after here today, is that result: 100% choice and freedom on how you spend your time. And we can help you do that here at passiveinvesting.com. We have an incredibly strong track record. We have deployed over 264 million through our rehab wallet loans, our lending side of our company. We have over 1.4 billion assets under management and strong investor returns, over 28.9% ARR to our limited partner investors. Now, guys, again, when we go through this screening and vetting process, this is not financial advice, tax advice, legal advice. So make sure that you consult your investing team before making any investment decisions. And I invite you, if you want to get on the list and join future masterclass and boot camps and get notified priority access when our deals open, visit passiveinvestingwithwhitney.com. All right. So to kick us off today, before you invest in any deal, like I said, if the number one myth is that investors tell themselves they don't have control, that means we have to put the investor in control. How do you put yourself in control? Well, before you invest in any deal, that means you have to understand your goals, your risk, and your timeline. Essentially, have your investment thesis fairly set, or a good idea of what that is. And then once you have that thesis set, now you can go source the operators, the markets, and deals that match that thesis. Now, I encourage you, go back to our January 2024 bootcamp, where we talk about how to set up your goals, understand your risk and your timeline, and also vet operators. That is a very important webinar for you to watch that kind of is part one to this part two in this series. So I'm going to do a quick little recap for you. So when we talk about understanding your goals, we want to make sure, do you like real estate? Do you like this asset class that you're about to go into? Do you believe in it as an investment vehicle? Okay. If you can't check the box yes on that you believe in the asset class, it's going to be really difficult to really understand how this asset class fits into your portfolio. All right. Then you need to fully understand, what do you need from your investment? Okay. Do you need capital preservation, cash flow, equity growth, pass-through tax benefits? Do you need to use leverage to amplify your returns? Do you need some sort of inflation hedge? And do you just need diversification? All right. Then you have to understand your timeline. Okay. What is your investment timeline? Where are you in your investing phase? Right? Are you in the accumulation phase? Are you on the younger side of thing and you've got time to scale a bunch of assets, like scale equity growth and stuff like that? Or are you more in transition phase, moving from accumulation into cash flow? Or are you in the cash flow phase? Are you approaching retirement and you need to start taking some of your equity chips off the table and ensuring you have enough cash flow as you move into retirement? Understand your phase. Now, the reason why I encourage people to start here to look at their goals and their timeline is because that's going to inform what kind of risk you're going to be able to take in an investment, right? So in theory, the lowest risk produces the lowest value, okay? But you also tend to have the fewer losses there, okay? Again, on the flip side, the higher the risk, sometimes the higher the value, but you're going to have more exposure, business risk exposure. Depending where you are in your investing timeline, that is going to help you match to what kind of risk you could possibly tolerate. So the number one of the top mistakes that I see investors make is that they're like waking up and they're like, oh no, I retire in 2 years and I got to build millions of dollars of equity. And by the way, I need to take zero risk doing. Okay. So we get what we call misalignment in your investing. All right. And so people take unnecessary risk in their investing to just try to build the largest portfolio possible. So of course, time on your side, the earlier you can start, the better, but make sure that you're aligning either all of your portfolio or at least part of your portfolio between like what your timeline is and what you can tolerate from a risk perspective. All right. The second question that I encourage people to look at here when they talk about risk is what's going to keep you up at night? All right. Now, this isn't so much risk mitigating the asset, but this will help inform you, like what help you specifically tailor your investment thesis. So do you get, is it going to keep you up at night if there's a reduced pause or a suspended distribution? Are you going into a deal where the business plan just seems really like risky, even though you see the value there, but you're just like nervous all the time? Is that going to keep you up at night? Are you nervous by capital calls or the potential loss of capital or the potential fraud there? Understand which one of these potential risks would keep you up at night, and make sure that you have questions in your vetting process to suss those things out. Right? Not everybody is concerned, especially if somebody's in their accumulation phase of their portfolio growth. If they're going to a strong asset and the cash flow is paused for a few months or a year, they're like, hey, the asset's going to be fine here in 2 or 3 years. We're going to all make our money. I'm totally fine with the cash flow being paused. Whereas somebody's in retirement, they may be living off that cash flow. That may be like, oh, a little bit of a hesitation. We need to make sure that we put deals into our portfolio that help address what's going to keep you up at night. Okay, again, create that alignment. All right, so that's a little bit of a recap. Let's talk about now, how do you put yourself in control? We first have to define what control really means here. Okay, so you guys seen me put this up quite often, but control is a verb, and it means determining the behavior of or supervising the running of. It does not mean elimination of all risk. Okay, so that's why we call it risk mitigation, but we're not risk elimination. All right. I remember I was talking to somebody from the legal field here a few weeks ago, and we were talking about zero risk investments. And we were able to blow holes through all the potential quote unquote zero risk investments out there. There's really no such thing. There's risk mitigated investments. Okay. What kind of control do you have? Think about this over other assets. If you're here live, I want you to go to the chat box, dump your answers in there. Think about, when you think about stocks, mutual funds or CDs, what kind of control do you have over those bank products or paper assets, stocks, bonds, and mutual funds? Or maybe like momentum assets like options, futures, and collectibles. What kind of control do you have over those assets? Go to the chat box and I want you to drop your answer in. Okay. And the reason why I want you to think through that, okay, is because when you're investing in passive real estate, we need to know what areas we do control. And again, that is your investment thesis, who you invest with, where you invest, and what deal you go into. All right. So again, our webinar that we did back in January, we talked about our investment thesis there. We talked about the who, how do we screen and vet the operator. Now we're getting into the where and the what we're investing in. So let's start with the where, okay? How do we screen or understand the market? Okay, this isn't so much of like, a yes or no type thing for people. This is about gathering information and making sure that you're looking at the same data that the operator is looking at. Because remember, they're putting out an offering memorandum, and that is a marketing tool. And great operators put out great data in their offering memorandums, but anybody can spin the data. So you need to know, how can I double check these stats? Where do I go to really fully understand the market, and kind of just like do like a quick little double check on where this deal actually is. Well, what are we looking for here when we're especially passive real estate, multifamily, self-storage, even businesses with car washes on them, stuff like that? We want to know it's about the location, okay, the market and the submarket that this asset's in. Okay, that gets us an incredible amount of security there and stability there if we fully understand, if we're invested in a good market with good fundamentals. So what are we looking for here? We're making sure we're looking for that populations are increasing, job growth is increasing, job diversity is present there, that we're not investing in a one horse town or anything like that, that we're looking at markets where there's multiple industries, say like banking and distribution and government and college, the college university system, something like that. There's multiple industries supporting that market. We're looking for income growth. What are the trends on income growth? Are people getting, are their paychecks growing? We want to see if that's happening. What's happening with crime and poverty? Are they coming down? Is the city investing resources into the area to bring down crime rate and poverty rates? Then we want to look at the business side of things. Does that state, does that municipality, and the MSA submarket actually favor business? And the ways we can kind of assess that is like if they're landlord friendly in the case of investing in multifamily type of assets, or do they just have favorable tax laws where they encourage business to come to that area? And we want to look at these criteria at the submarket level as well, okay? In addition to that, we want to understand the supply and demand in that area, especially if we're looking at things like, I would say anything, multifamily, self-storage, express car washes. We want to understand, again, we want to be on the right side of that supply and demand curve, all right? Now, again, real estate is immutable, or immovable, I should say. It's all about the location, right? Location, location, location. And if we're talking about express car washes, the location, you want to make sure you're on the right street corner or the right traffic count coming past you, okay? So that means we have to get really granular. Like if you're looking at a deal, it is worthwhile to look up the address of that deal and make sure that it is has good fundamentals for the market and submarket, okay? Okay, we don't want to be on the wrong side of town when we invest. So where do we find this data? Well, again, there's going to be a wealth of data in the offering memorandum that the operator puts out, but we want to make sure that that data is backed by reputable resources like CoStar, Marcus and Millichap, CBRE. Okay, those are great data sources. Now, here's the thing. You can go look at data on Marcus and Millichap and CBRE yourself as well, okay? CoStar, I believe you have to have a subscription to. But you can look at these public market reports. Colliers is another entity that you can go look at market reports. One of my favorite things to do is to plug in the address on a website called city-data.com. Okay, it updated, it's not gov, it's com, or niche.com, niche.com. Plug in the address there. And then you can get some cool color coding. You can look at crime rates and poverty rates and color-coded metrics. If you're on niche.com, you'll actually have an A, B, C, D, E rating, and why those locales are getting those ratings. So that can be a quick way for you to kind of confirm this market data. Okay, and if you have any questions about the market data, make sure you ask the operator for that data. And that's totally fine. The operator, they're your business partner. They should be able to provide that data for you. All right, so that's how we can screen the deal, okay, screen the market. Now, if you're talking to an operator, oftentimes in that intro conversation, you can say, hey, where do you guys most likely invest? And they should be able to wheel off a list of cities, like say for the multifamily, for their express car washes, whatever their asset class is. And so you can kind of start taking a peek at some of this market data ahead of time and say, oh, I like that market. That actually seems like a really good market. I'm going to keep this operator on my radar. But you also want to confirm, take another quick peek whenever you see a deal come out, right? Sometimes it can be a year or two before an operator puts on another deal in a particular market, and we want to make sure nothing has shifted there. All right, so that leads me to kind of the vetting and screening process. So what do we do here? Okay, so I have a two-pronged process. One of it is screening the deal. Okay, all I'm trying to do is in under 10 minutes, get to a point where I say, yeah, I want to dive deeper into the deal. That's the only purpose of this. I'm not trying to say, yes, I want in the deal. I know everything about the deal. That's not the point. The point is to spend as little time as possible to say, hey, I actually want to dig deeper on this, okay? So in order to get this, we have to understand what good questions are that should be in our screening process or in our vetting process. So again, if you guys are here live, I encourage you to go to the chat box. What do you think about these questions that I show here on the screen? Are these great deal vetting, deal screening questions? Like the questions are like, what is the preferred return on the deal? What is the equity multiple in 5 years? When do distributions start? Okay, what can I expect for a monthly return? Have you ever lost money? All right. I want you to go to the chat box, put in yes or no. These are great questions. These are not great questions, or maybe like somewhere in between. I want to know what you think about these. All right. A couple of people are like, I don't know. I'm not sure. Somebody says no. Ooh, somebody says yes. Somebody says, okay, we got another vote for yes. These are good screening questions. Okay. I'm gonna challenge that. Oh, somebody says, I like cap rates to compare. Ooh, you're speaking my language. We're diving into vetting there for sure. These only are about you. They are not about the deal, okay? So we need to arm you with what we call a basic screening framework. So in 10 minutes or less, these are the things that we're trying to tackle here. When you get a deal alert in your inbox, number one, is that deal alert from an operator you have already vetted, okay? If you haven't vetted the operator, push pause. If you like the deal, your first step is to actually schedule a call with the operator, okay? Is this an asset class that you understand? All right, so if you get a deal that hits your inbox and it's for, I'm trying to think like a ground up development on a like high rise commercial building, and you know nothing about commercial development, okay, push pause. Okay, don't look at the deal. We need to make sure that you understand the asset class first, because people get starry-eyed by the numbers. Remember, all these questions we're asking about you and the return you're going to get, they're not actually about the deal. Okay. Does this deal match your investing goals and timeline? Okay, so usually an operator puts a synopsis right in there. And so they're going to call out, hey, it's a 5 to 7 year hold. Here is the expected cash on cash. Here's the expected equity. Here's the expected equity multiple. Does that align with your goals? You're not concerned of what they are right now, but does that cursory look at those type of metrics actually meet your goals? Okay. And then is there anything popping out at you here that wouldn't allow you to sleep well at night? Okay. Remember, if there's no cash flow, and you need cash flow, you're not going to sleep well at night being in this deal. Okay. If you need extreme equity growth and no cash flow, and that's all it has is cash flow, again, you're not going to sleep well at night because it's not going to align with your goals. And then if you go back to our webinar that we did in January, does it have one of those 8 red flags of investing that we talk about so often here? Okay. And if you guys have questions on that, we can save that to the end. I'm happy to recap those for you. Now, if you can get through these quick little vetting questions just by taking a quick peek at this email, guess what? All you're doing now is putting a time block on your calendar and you're looking at the deal. Okay, maybe that time, I encourage you to do it in the next 24 hours. Okay, but drop 30 minutes on your calendar, make a date with yourself, hold that date. Okay, because now you've gotten to like a high level yes, but that yes is just saying, yes, I'm interested in the deal and I want to dig further. Okay, otherwise, you can move that deal off your plate. Okay, and look at other things. All right, why do we have a screening process? Okay, something really quick. Because it's going to save you a lot of time. All right. It'll keep you looking at deals that do not align with your investing goals. And therefore it's going to save you a lot of headache. But also the screening process and even getting into the vetting process is going to save you a lot of heartache from getting starry-eyed and getting into deals that just don't match your investing goals. But it's really the actual vetting process is where the rubber meets the road. So before we get into the vetting process, here's kind of like my, if I were kind of putting this into play, I open up a deal and it says, I'm going to look at that deal. I'm going to ask myself, is this from somebody I know, love, and trust already? Yes or no? If it's not, again, remember, my first thing, especially if I kind of like the deal and I can answer yes on the rest of the questions, like it's an asset class I like, it meets my goals, it's in a location I love, it's a business plan I love, hits multiple pillars of wealth building, there's no other red flags. My first step though isn't digging into the vetting the deal, it's scheduling the call as quickly as I can with that operator and doing my vetting on the operator. Okay. All right. But once I have cleared that hurdle about have I vetted the operator, again, like I'm gonna, dive in, look at the asset class. Do I love the asset class? For me, I'm focused on things that have cash flow or cash flow and equity, like multifamily, self-storage, express car washes, real estate debt. I think is fantastic in this environment from a short-term investment frame of mind, but also a long-term investing frame of mind. Okay, it's going to bring in cash flow, will allow me to leverage my current assets, my current capital, that I can put it in an environment where I'm earning a better income than I am at the bank in a more stabilized environment. Then I'm going to look at the open deal. Okay, and again, tapping into the goals, the timeline, the risk, the location that I want to be in. All right, but again, remember, it's the vetting is going to be where the rubber meets the road. So set aside time for the vetting. Now, guys, we have about 30 minutes left in today's presentation, and there's going to be lots of terms that I go through here. But if you are unfamiliar with these terms, like cap rate, net operating income, pro forma, T12 financials, you can go to passiveinvesting.com. We have a little video tutorial on a majority of these terms there. You can also visit our YouTube page. Those videos are posted there as well. And we deep dive into just quick little 3-minute videos to help you understand what a preferred return is and what is the IRR. I'm gonna hit a lot of these terms at a high level here, but if you need a deeper dive, check out those resources. And if you want to connect with me and I can send you these resources, you can make sure to go to passiveinvestingwithwhitney.com. All right. So here is my vetting framework. Okay. I'm a member of a lot of different communities and investing groups. And I feel like every single investing group and every investor I meet has their own due diligence checklist, and everybody's sharing their checklist. And that's fine. That's amazing. But the most important thing you can do as an investor is take these checklists and make them your own. And so really, I have to kind of understand when I look at all these checklists, when I ever even look at my checklist, I'm trying to evaluate 7 different areas. I'm trying to evaluate how well does this asset preserve my capital? How does it create cash flow for me? How does it create equity for me? Does it create tax benefits for me? How is the leverage being used on the asset? What kind of inflation hedging is there? Okay, and then I'm trying to also recheck everything on the operator before I invest. So let's dive in. Number 1, and guys, I encourage you to take notes. This recording will be posted on YouTube, so you can go there. You can watch it over and over and over again, creating your notes. That way you can create your own due diligence checklist. But when we're talking about deal vetting and we're looking specifically at the category, does this deal preserve capital? We want to make sure that we understand the market. Okay, that is top priority. And again, we talked about how to screen the market earlier, but I want to confirm all the statistics in the offering memorandum: the population, the job growth, income growth. How is poverty and crime trending? What is the tax structure in the area? Okay, what other legal hurdles are there? Okay, I also want to understand what are the sales comps in the market, right? If you're going in a multifamily building or buying a self-storage property, I don't want to be the top dog. I want to see there's some examples of properties that have sold, that have repositioned their asset and sold, that are higher than what my potential comp exit is, or the purchase price of the comp as well, right? Then I want to also, from a reserve perspective, I want to make sure I understand how much capital is that deal holding? How much capital reserves are they holding? Both operational reserves as well as capital expenditure reserves. The bank only requires generally 3 to 6 months of reserves, but is the operator actually being more conservative and holding 6, 8, 9 months or more of reserves. Also, you want to understand that's a lot of cash to be sitting in the bank for some of these assets. That's millions and millions and millions of dollars. Okay, are those reserves being deployed somehow in another investment? Okay, and if it is, where, and how liquid is that investment? Okay. We also want to see sales comps higher than the subject property. We already talked about that. And then we want to make sure that there's a clear exit strategy with different contingency strategies. That there's a plan A, plan B, plan C of how to reposition and sell that asset. When it comes to deal vetting of the cash flow, we want to look at some other things here. Okay, we want to make sure that we're looking at the pro forma. Okay, the trailing 12, guys, are financials that are backward looking, at the previous 12 months. How did the asset do there? And that's generally going to be with the the current seller of the asset. And pro forma is going to be a forward looking projection, okay, an educated best guess. And I mean, super hyper educated guess of what can be expected performance of the asset. Okay, we want to make sure it is conservative. So many people say conservative. We actually want to make sure it's truly conservative. We want to make sure income growth of the asset is level set with expectations. So maybe current market says there's a 10% year over year rent growth. Is the operator actually underwriting 5% a year, like really stress testing and bringing that income growth down? Same thing with expense growth. Maybe expenses have only been growing at 2% a year, but did they put 4 in? Okay, year over year. Vacancy. Now you have vacancy, especially if we're talking about multifamily and self-storage, you have true vacancy, physical vacancy, that unit is no longer occupied, or you have economic vacancy. Somebody's in the unit, but they just aren't paying. We want to make sure that we understand both of those vacancy metrics and they're accounted for in that pro forma. Okay. And that is very important because it's going to feed into what type of returns that operator is going to be able to show to you. And we want to make sure that there's conservative cash on cash returns and equity returns being shown. If you're investing in a deal like a self-storage deal or a multifamily deal, we want to make sure that there's a really low break-even number there, that essentially it only has to perform at, say, 50 to 60% break even to cover all the expenses. Now, that doesn't mean investors get paid, but all the expenses are being covered at that level. Okay, that'll allow us to not lose the asset that feeds back into capital preservation. Okay, with cash flow, we also want to make sure that there are rental comps higher than the current comps rental income at the property, from the trailing 12, but also forward looking. Okay, again, we want to make sure we're not the top dog in the market. And then for me, I'm always looking for the cash flow as an investor. How is that cash flow coming to me? Is it coming to me monthly or is it coming to me quarterly? Some deals, don't have any cash flow at all. Some deals are like biannual or annually. Like, I want to make sure that, is the distribution schedule that matches my investing goals. All right, so I feel like I skipped a slide here. Yep, there we go. Deal vetting, equity. All right, so here in this pillar, we're making sure that we are underwriting the business plan's ability to increase the net operating income on an asset. Okay, if we're talking about express car washes, this is going to be expected gross income, but they operate pretty similarly, NOI, EGI. Essentially, we're looking for how is the operator increasing income, decreasing expenses, adding additional streams of income, okay? And we also want to see sales comps higher than the subject property, because that'll prove that even if we increase the NOI, that it's being valued at that higher valuation. All right, returns and sensitivity. Okay, we'll dig into that further, but we want to look for reversion cap rates. Is the operator looking at cap rates expanding, meaning the market is softening, or contracting, meaning the market's getting better? We want to make sure operators are underwriting what we call stress testing the asset and say, okay, maybe the market's getting better right now, but what happens if all of a sudden it turns around and went the other direction? Okay, does this asset still work? Waterfalls, we'll talk about the difference between capital stacks of waterfalls in a second, but when we talk about it in terms of protecting our equity as a limited partner investor, we want to reward the general partner for their work. Okay, we want to make sure that it's aligned. But one thing that I look for, and something that we don't do here at passiveinvesting.com, is I want to make sure that there's no GP catch up in there, meaning we have true alignment between the limited partner and the GP. And then, as far as equity, I want to make sure the deal's not getting feed to death. Okay, we'll look at the different fees of acquisition, asset management, property management, capital event, and construction. Okay, all of those are warranted. The operator needs to be able to pay to keep the staff employed to run the asset, but we want to make sure it's not being feed to death. Are the performance fees aligned? All right, so I'm going to buzz through this, but if you're here live, again, this is being recorded and posted. If you're listening to this later, go and watch the video. But we want to make sure when you're vetting a deal that you actually understand how to read the financials. And some of the things that I focus on when reading the financials is the return. What is the cash on cash return? What is an internal rate of return? Annualized rate of return, and then the equity multiple. Okay, notice I didn't say preferred return here. Okay, because the preferred return is not a return at all. It's actually a hurdle, a performance hurdle. Okay, so the actual returns that you should be focused on is what is the cash on cash? And ideally, the operator is giving you year 1, 2, 3, year 4, 5 cash on cash projections. Okay, they're going to give you the internal rate of return projections, and then all the other metrics as well. So cash on cash simply, and again, you guys can go back to passiveinvesting.com on YouTube or passiveinvesting.com website and get in-depth videos on all these different terms. But cash on cash is the annual dollar income return divided by your total equity invested. That gives you your cash on cash number. An internal rate of return is a little different. It's a calculus equation. This is always a fun thing when investors ask me this on the call, and I'm like, how good were you at calculus? But an internal rate of return, the difference between internal rate of return and the annualized rate of return is that the internal rate of return is actually going to help you understand when you get your initial capital back. Okay, so the higher a project's internal rate of return, the more desirable it can be to undertake. However, it can also mean slightly more risk. Okay, so we need to, again, understand we shouldn't just chase the highest IRR. We need to understand the risk of the project, and is that something that we want to take as an investor? So annualized rate of return is a little bit easier to calculate, but there's 2 different types. So when you're looking at the deal, which type of ARR are you looking at? Are you looking at ARR excluding the disposition funds? Are you looking at it including the disposition funds? Okay, so if it excludes the disposition funds, this calculation does not include the return of capital. If it includes the disposition funds, the ARR actually includes the profits, the capital being returned and the profits. Equity multiple is probably one of my favorite things to look at because it's easy to understand. Okay, but here the thing is it's not a number that you can compare apples to apples, project to project, because they have to have the same timeline. Meaning I can't have an equity multiple compare an equity multiple on a 3-year project to a 7-year project, okay, because they have different timelines. The number that I would compare there would be the internal rate of return. Okay, remember that calculus equation accounts for us getting our initial capital back. But an equity multiple, if I'm looking at multiple projects that all have 5-year, projections, then this can be a super, kind of simple term to compare because it's really the present value of the property divided by the amount being invested. If I put in $100,000, am I getting 2x in 5 years, or am I getting 2.25x in 5 years or more? Now, remember I said the preferred return. I know a lot of investors, when they look at the deal, they race to open it and they're like, yes, it has a pref of 7% or a pref of 6% or a pref of 8%. And they go, ooh, I'm going to invest in the deal with a higher pref. Okay. I kind of cringe. That's kind of a cringe-worthy comment. And I'll tell you why, because that's just a hurdle. Okay. It's not an actual return. You can actually have a lower preferred return deal, something with a 6 pref or a 7 pref, and it actually the exit multiple or the equity multiple in the IRR are actually higher. So it's going to have a greater potential of growing your capital. Whereas you can have a deal that has an 8% preferred return and the internal rate of return is way lower. Okay. So again, you have to understand how these numbers move. So the preferred return is AKA, also known as the pref, describes the claims on profit, meaning the operator is saying, in my deal, I'm going to give you the first 7% of returns before we start splitting cash flow and capital. That's it. Okay. And so after that, they can be, we can get into what we call the IRR hurdles after that. But again, this is not a guaranteed return. I hear people use the pref as, they call it a guaranteed return. That's actually not the case. So here's a good example. Here's a deal with a 7 pref and an IRR hurdle. Okay, so here we've got the capital stack. Okay, then over here, it'll tell us the 7% preferred return. The first 7% goes to the investor. And then after the 7%, the investor, the LP and the GP split 70-30. Okay. And then it tells us what happens afterwards on the member ownership. Okay. After that 70% is met to the limited partner to 13% IRR. Now that's the IRR hurdle. Then the split changes from 70-30 to 50-50. Okay. You could probably make more money in a deal structure like this than you could at a deal with a higher preferred return and a different type of split. So again, you have to really understand how these numbers move with each other. Okay. Sensitivity analysis. Okay. I like for this to be in the offering memorandum. When I'm vetting a deal, I want to make sure the operator has stress tested the numbers. I want to see that stress test or sensitivity analysis in the deal. So essentially, this is the calculation on how each factor, okay, like net operating income, or in this case, the cap rate, would affect a change on the profits. So, but the sensitivity analysis can be manipulated. This is why it's so important. You need to vet deals that actually have good pro forma conservative metrics, okay? Because if the operator has used outrageous income growth, kept the expenses so low, the income's so high, and the vacancy is so low, and they're unrealistic for the deal, guess what? It's going to throw off the entire sensitivity analysis. Okay, so we want to make sure the operator, when you look at their pro forma, is using realistic numbers there. Okay, so this is an example of a sensitivity analysis focused on what happens when the cap rate changes. So for this particular deal, the deal going in cap rate was 4.2%. So we showed what would happen if the cap rate got better, the market got better, what would happen here? But we were actually forward thinking, going, wow, we really think the cap rate's going to expand. And what happens if it expands by 80 basis points? Okay, 0.8%, 80 basis points. Like, what happens to returns? So I see investors get so starry-eyed on the market getting better. You've got to look at what's happening if the market goes the other direction. Okay, so those are our first 3 areas. When we're putting together our deal vetting sheet, we're looking at those questions to include that help us identify, is capital being preserved? Is cash flow being preserved? Do we have good quality numbers to help us assess what is the true equity return on this deal or potential equity return on this deal? Now we can get into some of the more, I would say, not minutia, these are still very important, but the kind of like once you've covered the first 3, these are the things that are kind of like bonus. Okay. Does it have tax benefits, right? Number 4. Okay. Tax benefits are important for you. They are a goal. You want to make sure you've got a few columns on your checklist to understand, is is the operator utilizing depreciation in the deal? Or actually, does the deal actually kick off depreciation, right? If it's an equity deal, more than likely, yes. If it's a note fund deal, more than likely, no. Okay, but then how is the operator utilizing depreciation? Are they utilizing accelerated depreciation? Are they doing a cost segregation analysis? Are they going to tap into bonus depreciation here? Okay, how are they sharing depreciation with you? Are they sharing it pro rata or in some different structure? This blew my mind a few years ago. I reviewed a deal and it was an equity deal, not one of ours here at passiveinvesting.com. And the split of tax benefits was 50-50. And I was like blown away. I was like, wait a second, the equity is being split 80-20, but I'm getting all the equity, but I'm getting none of the tax benefits. So guess what? I'm going to get a big tax bill at the end of this deal. I was like blown away. I was like, why would we do this? So make sure that you understand like how that there's at least pro rata sharing and tax benefits to help you shelter income. Okay, this is one of the reasons, one of the most powerful strategies, one of the reasons why we invest in real estate, right, guys? Okay, and then also, are they utilizing a 1031 exchange at the end? And it's not always a guarantee. 1031 exchanges can be really hard. Last year in 2023, it was super hard to get a high quality 1031 exchange complete. Okay, so oftentimes it just didn't make financial sense. But does the operator have the capacity, okay, and the intent to get a 1031 exchange done? That is something you want to match with. Number five, how is the operator using leverage? Okay, this is not all about using fixed rate debt, okay, at the lowest loan to value. Okay, that is super conservative approach, but a better approach is to making sure that the debt that's being placed on the deal matches the business plan. Okay, that's where we saw a lot of people actually get in trouble and lose assets, is that they were using debt that actually did not match the business plan of the deal, and they were getting themselves in hot water. They were essentially juicing returns. Okay, but they actually, if they couldn't reposition the debt, it was going to be problematic. Okay, so when you look at that, you want to see who's lending on the deal. Is it public lender, private lender? Okay, how's the capital stack? We'll take a look at a capital stack here in a second. You know, how is the money lining up? What's the loan to value on the asset? Okay, is it recourse debt or non-recourse debt? Okay, on larger assets, I love non-recourse debt. We don't want to be liable for it at all. Is it a fixed rate? Or if it is a fixed rate deal, that's fantastic. But if it's adjustable rate, you know, what's the lock on the adjustable rate portion? Is it at least 3, 4, 5 years? Okay, is there opportunity to extend it? And is there a rate cap on that? Okay, so if it's floating rate, is it capped? All right. We want to make sure, you know, is it interest only for at least the term of the hold? And is there opportunity to extend here? Okay, and that's going to be, again, matching the debt to the business plan. And then is this being calculated into the break-even operational expenditure of the property? So if you're being shown a break-even of like 55, 60%, is the debt calculated in there? It should be, okay? So here's the capital stack. This essentially, it's different than the waterfall. It's going to tell us the different layers of money. So senior debt, this is typically like your Fannie Mae, Freddie Mac type loans, even a private loan, okay? Then you've got your mezzanine debt, okay? This is going to be like your secondary loans, your supplemental loans, lines of credit, right? Then you get into your equity part of the stack. So debt is on one side, okay? And then equity is on the other side. And then we've got, you know, on our left-hand side, you know, the further you go down the pyramid, okay, potential return is low, but so is the risk. And the higher you go up the pyramid, the potential risk increases, but so do the returns. Okay, where do you want to be in this structure? All right. Now remember, I said the capital stack is different than the waterfall. Okay, the capital stack shows you the different layers of money. Okay, the waterfall actually tells you who gets paid what and when. All right, why is it important to understand the difference between the two? It's because the limited partner sits behind all of the debt in a profit sharing position. Okay, unless otherwise noted in the PPM, the limited partner is going to be on the equity side of the deal. Okay, so they're participating in distributable cash flow after all expenses, fees, debts, and reserves are paid. All right. So if that's where they are in the capital stack, we now want to know who gets paid what and when. Right. So let's take a look at an example. So I'm going to back it up just a second. This is the capital stack. All right, we got the debt, the limited partner, general partner, and that tells you who's bringing what money to the table and who has what ownership. This picture, again, we've already looked at the partnership structure when we were talking about our preferred return in an IRR hurdle, but this partnership structure actually tells us also who gets paid what and when. So the first 7% of this deal goes to the limited partner investor. After that, funds are going to cash flow and ownership are going to be split 70-30 until the limited partner hits a 13% IRR. And then after that, it's going to be a 50-50 split. Okay. All right. Number 6 in your deal vetting, when you're putting together your checklist and you're organizing all your questions, you want to take a look at inflation hedging. And essentially, we've addressed these questions in different ways, but essentially, is the operator locking in good quality debt today? Okay, that's going to be paid back with future devalued money. Okay, and not only that, but do they have the ability to raise the income on the property? Okay, continuing to pass through increases through the property, and also adjust the expenses regularly. Okay, so that you lock in the debt, but if you're getting into an asset, like say you buy a single family rental and there's no way you can increase the rents, that may not be the best inflation hedge. Okay, or if you can't increase the rents, but your expenses are just going out the roof, maybe your tax bill doubled and your insurance bill doubled, okay, you don't really have a good inflation hedge there. So we want to make sure that it's not just about locking in the debt, that we can actually raise the income and pass through increases in expenses, that are reflected in that raised income on the property. All right. And then line item number 7 is making sure that you are investing with high quality operators. So we've kind of come full circle here, guys. We want to, again, you started off the process vetting the operator, okay? Again, before you go into a deal, you want to make sure that everything that you know about that operator, especially if it's your first time investing, holds true, okay? That there's been no material changes in the business, that if you feel more comfortable, talking to, investor referrals, that you've done that. Even really quick, this is something I do. I ask for names of previous LLCs, entities that they've, assets they have in LLCs. I'll go on the Edgar .gov database, like with the Securities and Exchange Commission, and I'll type in the LLC and I'll look up like, hey, have they been compliant with all their filings? Okay, that's a really simple check there. There's another database called formd.com that can be a little more user-friendly, but it's pulling from the Edgar database. And then I'll also just use a search engine like Google. I'll type in the operator, legal, operator's name, lawsuit, managing partners, legal, lawsuit. And I'll just make sure that nothing has crept up here. All right, guys. So your next steps, before we open up the floor for questions, I want to make sure we kind of put a beautiful bow on this, is to make sure you're notating all this. That I organize my spreadsheet, something like this, if you're watching via video, I've got all my questions, in a spreadsheet on the left-hand side, and then I'm grading them. Is it ideal, good? It's just simple check boxes. I might make some notes. And then if I come across anything in that line item, I'm going, ooh, I need to ask more questions, okay? Operators really try to do their best to put as much information as they can in the OM, but sometimes it can't all get packed in there. So if there's something that in your vetting process that you don't have the data for, okay, don't assume that it doesn't exist or the operator didn't want to share it with you. Ask, email. Okay, if you have any questions, ask. Sometimes information is not just in the OM, the offering memorandum, but if the operator puts out a webinar, be sure to look at that too, okay? Because sometimes they're going through due diligence and they get updated information in due diligence, okay? Watch the webinar. A lot of questions can be asked there or answered there. Okay, but if you still have questions after reading the offering memorandum, looking at the investor webinar, make sure to email your investor relations contact. Okay, and then it comes down to making a decision, putting in a soft commit on that deal. Okay, getting your allocation set, right? Now, keep in mind, as the market changes, so should your expectations. They should adjust, with the market, with the asset class, and how everything cycles, right? Guys, we're gonna just sum it up if my computer can catch up. Your action steps, make sure that you're creating alignment by defining your goals, not defining your goals, defining your goals, defining your timeline, defining your risk tolerance, creating your deal screening process, and creating your deal vetting process. Guys, if you're here live, we're going to open up the floor for an Ask Me Anything session. Oh, actually, before we do that, just if you guys are looking for more advice, financial advice, you can also, get my Money for Tomorrow book off at biggerpockets.com. Pre-orders are still open. You can go to biggerpockets.com/Whitney. And also, if you're looking for more information like this that we presented here today on how to set your investing goals, your risk, your timeline, vet operators, markets, and deals, learn other skills related to passive investing, join us at passiveinvestingwithwhitney.com.